Hi everyone, welcome to a new video. So today I'm going to be talking about psychological levels in stock markets, in indices, and obviously that's big news this week because the Dow Jones in the US finally hit the 30,000 level, and you can see here this is a 5-day chart. See it hit the 5,000 on Tuesday evening just before the US close, and then on Wednesday today the market's declined again. I want to talk about this because Tuesday evening there was so much hype. Dow 30,000. It's something that some market watchers have been predicting for years. Massive bulls on the Dow. President Trump did a press conference celebrating it. Stock market's never been that high. A ridiculous number of new records in his time as the president. Now, obviously, I've done previous videos on this, but as the president, he's actually not the one who's achieved the best return for the stock market. It's not even close. But yeah, these psychological levels for a long-term investor, I think, mean very little. We reached 30,000 level, but to be honest, we were 4% away from it at the beginning of the year. The Dow has gone up 4% in 2020. Now, obviously, that's a lot less than the normal. The S&P, for example, I think is an annualized average return of 9, I think. It's like the 7 to 11 range, that kind of thing, usually. So 4% is low. Obviously, it's been a rather exceptional year, to say the least. But I mean, if you look at it in comparison, this is the Nasdaq in the turquoisey color, the S&P in the orange. Then in the other blue, you have the return of the Dow Jones, and you can see here that the Dow Jones has returned 4%, approaching 5%. But the Nasdaq up here is up for 40% on the year. 40%. A ridiculous multiple compared to the Dow. So when you're looking at this and saying, oh wow, the Dow has done really well this year, buy the Dow, etc., etc., this is not something that should drive you to invest. Like, you shouldn't be buying the Dow right now just because it hit 30,000, or just because it's slightly below that 30,000 level. Don't go and buy a Dow ETF because that's just not good investing. The Dow here has reached an interesting level. And, when the S&P equally broke the 3,000 level earlier this year, I believe, it might have been actually last year, that was equally an important level. But that's not something that in the long term is going to affect you. Like, yes, yesterday it broke that 3,000, but today it's fallen down slightly. The irony of Trump being massively, celebrating this victory is that part of the reason that Dow rallied on Tuesday was because Trump finally acquiesced on the election and has allowed the transition process to start. While he hasn't conceded, I mean, that's a big step in the right direction, and that's positive for the markets. The other thing was Janet Yellen being indicated as the next Treasury Secretary, which is seen as bullish for the markets. But really, I think this movement in the Dow is pretty short term. Obviously, I do think it's going to come above this level again. God knows when, but I'll be surprised if it takes very long to do so. Certainly by next year, it will be up here. And, as usual, predicting the markets is a fool's errand, but an entertaining fool's errand. So I'd say from here, I think we're going to see a little bit of a decline in the Dow. Obviously, the stocks in the Dow are more aimed towards an open economy than they are to, the tech stocks of the Nasdaq. It's got a few tech stocks in there, Apple, etc. But, things like Boeing in there, which has had a good week this week after the MAX, 747 MAX was allowed back into flight by the US regulators. Things like that are very reliant on the world reopening. And while we are getting there with vaccines, etc., in the past few weeks, obviously that's caused massive bullish moves in US markets and other markets. We're not there yet. I mean, I read something the other day that was about how we're probably about halfway through the crisis. 8 months in, 8 months left, that kind of thing, by the time you've vaccinated everyone. So if you're looking at another 8 months of restrictions, of lockdowns, especially in Europe, where the restrictions have been more severe, more, enforced. In the US, I think that's a completely different ballgame for somebody like the Dow. you might see what we had earlier in the year where it underperformed relative to its peers, to the S&P and the Nasdaq. Sorry. So the way you got to look at it is, yes, it's great with Dow's at this level, but it was always going to get there at some point. And this almost like mythical 30,000 level you've seen in the press a lot recently in the past 2 days really being celebrated. It doesn't mean that much. It's just another number. And we will get above it in the next few years. And there'll be another level that's focused on Dow 40,000, Dow 50,000. And we'll probably get there one day. It might take a long time, as this has, but when we started the year so close to it, it's not that surprising that we got there this year. Obviously, it's been a very roundabout route from the massive dips on this chart. But yeah, I mean, I wouldn't be buying into the Dow now, because you can see from this year, you're buying into an index that has underperformed its peers. 4% in a year like we've had is still not bad. But when you look at the 12% from the S&P, the 40% from the Nasdaq, I don't necessarily agree with those returns, with those valuations, especially in the Nasdaq, but that's what's happened. You can't predict that. Now, you should be in these markets if you're an investor. You should be ETF. Even if you're picking individual stocks, I would always have positions in ETFs that cover broad ranges, in funds that cover broad ranges, because then you're exposed to everything. And you want to be, because you don't want to miss that 40% return in the Nasdaq. Now, I'm not a fan of how they're valued. I'm not a fan of the prices some of these tech stocks are getting. But I do have some exposure to the Nasdaq. I do have some exposure to the S&P through ETFs, through funds, because you have to if you want to achieve that solid rate of return, outside of individual stocks. So, if you weren't in the Dow already, which you should have been for diversification's sake in an ETF sense, then sure, fine, maybe this is a time to buy in, but I wouldn't load up on a position here in the indices. This is not a massively important level as a long-term investor. Maybe if you're short-term, you're saying we'll get back to the 30,000, we'll rally, or, this morning you went, we're at 30,000, it's probably going to come down from there. If you're trading on that intraday, that few-day basis, then maybe. But if you're a long-term investor, which you probably are if you're watching this video, if you're like me, you should already be exposed to these markets. You shouldn't be buying in at these levels. I think we will, as I said, fall from here, but it will get back up to this level at some point in the near future, and probably stay there. I mean, the markets have changed massively in the past few years, in the past decade. Levels we're at would be astounding to, if you went back 20 years and asked someone, would you expect the Dow to be at 30,000, they'd call you crazy. But that's why you always have to be in, because you can't predict where this market is going to be next. I'm not saying it's going to happen, but if I said to you, by 2030 the Dow is going to be at 100,000, you'd call me crazy. But ultimately, no one knows. And there's a very small chance it could be. You don't know. So that's all I would take from this. This is not a buying opportunity as a long-term investor, but you should be in these markets, even if it's a small position, even if you've got most of your money in individual stocks. Having exposure to these broader indices is good. In the UK, in the US, in Europe, the DAX, the CAC, those kind of things, you should really be exposed in some way to them, because these things can rally from nowhere. And you want to catch that return. Now, certain stocks you're in might not respond as well to that. It's very unpredictable, so you should be always exposed in some way, in my opinion. Anyway, that's all for this video, guys, and thank you very much for watching. As usual, this is not financial advice. Please do not take it as financial advice. This is just for entertainment purposes. Do your own research, form your own opinions, and talk to a financial advisor if needed, if and when needed. And yeah, thank you very much.